Next up, we have Mr. Tony Bowker from Bank of the West. For those of you who have... Welcome, Tony.
Good morning, Chris.
Good morning. For those of you who have seen some of our live broadcasts before, you may remember Tony from Brewbound session 2017 in New York City. I think you chatted with my editor-in-chief, Jeff Kleinman. You chatted a lot about the age of promiscuity. That was the one takeaway that everybody seems to talk about from that interview.
Yeah, I remember that, but I never missed Brewbound, Chris. So, yeah, happy to be back. I'm just awed by your energy, back-to-back interviews. This must be draining.
I'm doing this for 5 hours. That's why I got coffee here. I had my coffee earlier today, so I'm just going to be fueling up on caffeine and staying alert.
Thanks for doing this.
So for some of the viewers that maybe aren't as familiar with you and your background in the beer industry, maybe tell us kind of how you got started, I believe back in 2000 as the CFO of Goose Island, correct?
That's right. Today I'm a banker, but I spent many years in the industry. I became a customer of the Goose Island Brew Pub in 1989. It opened a block from my house. And at that time I had another career, but I was an enthusiast for beer. And before that, the Midwest was a beer desert. And so here was a little oasis in my desert, and I became a customer and as part of the community, and saw the impact of the community that beer can bring in bringing people together. And that really flourished. And 10 years later, we sold the company I worked for, and I joined John Hall at Goose Island in 2000 as CFO.
And what was it like in the early 2000s growing a brand like Goose Island, and how different is it today for CFOs trying to grow a brewery now that there's almost 7,000 of them?
Yeah, that's a very broad question. Today, we're moving on from promiscuity, and it seems to me that the analog is a jungle. And back in 2000, there weren't too many animals in the jungle, and it was the issue was finding food sources. And if drinkers' dollars of food, there were some very big animals in the jungle, and we were tiny animals. But if you could avoid the big animals, you could find food. And now today there are taller animals, there are faster animals, there are bigger animals, there are stronger animals, and you've got to be the smarter animal. And back in 2000. Having really good beer was the point of differentiation. We were selling really good beer against what we considered not so interesting beer. And then roll on 5 years, and there's competition. It was more important to differentiate ourselves with not just through good liquid in a glass, but a story around the liquid, and then being able to tell that story and engage our partners at the wholesale and the retail level and drinkers with the story. And I think today, there's lots of good beer everywhere, thank God. There's some really good stories. Yep. And now the differentiating point that I see from my perspective is how smart an animal we are in going and finding that food. And that's the route to market and partnerships with the wholesalers and retailers. But it's while beginning a few years ago, but getting harder over the last year for a CFO, finding sources of money and managing growth is becoming ever more difficult as we see the level of professionalism in management of the healthy breweries. The bar is raising all the time.
So what kinds of breweries do you like to bank? What are the characteristics of a brewery that you want to lend to?
Well, my banks tend to look at business and lending with a very similar set of rules. We have the same kinds of constraints. Money costs about the same, and so it's really first of all, fundamentally to have a cash flow stream and a good plan. Management with who's able to who understands their business, and while they're projecting growth, because that leads to the needs for capital and the relationship, but to have a realistic view of it and to be able to support projections with making assumptions that that are supportable by facts and trends.
Yeah. Are you still seeing examples of companies that are perhaps over projecting, or in your mind might be over projecting future growth? Like, are people still very, bullish on where they're headed, even though we're seeing, a slowdown and we're seeing all this competition?
Because really, well, yeah, the simple answer is, yes. As you will talk to a lot of people who are ambitious, and I've always said that it takes unreasonable people to change the world. It has to be people who see things that other people don't, or believe in things that one could be skeptical about. But absolutely, there's optimism, and there are entrepreneurs with the idea of building, and they will come. But I think in terms of financing those dreams, the bar is raising in terms of the level of skepticism and the need to support with credible assumptions.
Yeah. Now, we have seen a number of examples over the past year and a half or so of breweries finding themselves in a distressed situation. Here in California, there was an example, obviously, with Speakeasy and Magnolia. I've heard sort of that 21st Amendment was able to stave off some potential downfalls there. I believe that they were in some pretty serious debt situation with their bank, but tying up with Brooklyn kind of helped them out there. So it didn't get too serious with them, but across the country, I mean, you look at Green Flash, you look at Smutty Nose, we're seeing more and more examples of distressed breweries taking on too much debt to grow, to expand too quickly. Do you expect to see more of this as we move forward?
Well, I read Brewbound too, so I've seen all those stories. But do I expect to see more? I believe there will continue to be failures as capital is unrewarded, and for the breweries that have expanded on the basis of private equity funds. We know that every private equity fund, save some family offices, some exceptions, are going to close out. They need to exit at some point. And I think that's just on the financial side, on the money supply side, it's going to produce some stress. And on the other hand, that the rule of thumb, and I was in through my years at Goose, was that unless you could produce at around 80% of your capacity, just in terms of capital invested and the cash flow that generated by putting volume through it, unless you could reach about 80%, you weren't rewarding your capital. And years later, I was in a session a little earlier with Chris of Modern Times, who have an excellent track record of financial planning, and he's still using that 80% yardstick. So let's say that if a brewery a production brewery is not producing around 80% of their potential capacity, it's likely not sustainable.
And I guess the situations that, take Green Flash, for instance.
Yes.
What Mike has said is that they shouldn't have relied on so much debt financing to build their second facility. They really went out and chased new volume in states, new distribution for the source of their volume. And in some ways, it seems like that was the only thing keeping the business afloat, and it was a bit of a house of cards, and the house of cards kind of came tumbling down.
It was a very big bet. And I think now, in retrospect, it's easy to see that the timing was awful. But my understanding is that Green Flash financed the expansion to the East Coast, which the strategy, was well laid out. And if it had been executed a couple of years earlier, it may well have worked. But as it happened, they financed with debt, and the debt was structured so that it had a move from construction into term loan, which is an important waypoint in the evolution of debt. At about the time the brewery came on stream with really no volume, and so it wasn't returning any of that capital, and that produced a great deal of financial stress on the company.
Interesting. So, in terms of deal making, We talked with Ryan Lake from OMAC yesterday, talked a little bit about how it's been kind of quiet this year. There hasn't been much activity. There have been a few smaller transactions, but nothing too crazy. Do you expect it to remain pretty quiet, and if so, why?
Brewery equity transactions and consolidation.
Yeah.
I think that new money is looking at, as I listen to investors, is very cautious and has a degree of skepticism about the industry. I think so. The opportunities for investment are few. I think that we're more likely to see brewers with a solid operating model and have a good management skill set and a strategy to acquire capacity and brands in breweries that are not faring so well at the prices that are realistic. And I think the valuations, we hear that valuations are coming down to realistic levels. The bubble is gone, the magic is gone. Now breweries are being evaluated much as any other consumer manufacturing business, that there's not a premium in beer, and perhaps even there's, given the overall trend, the global trend in beer consumption, there's probably an assumption that investors are likely to make, that the whole market isn't going to grow. If you're going to get share of throat for new drinkers to justify investment, that you have to be really clear and about where that's going to come from, where you're going to find those new drinkers,
Yep.
and with a differentiated liquid or brand. But it's probably not going to come through geographic expansion on its own, because everywhere in the jungle there are smart animals feeding on those sources already.
Yeah. So if you're a brewery that took on some debt to expand, and maybe you're starting to approach that time period where the bank is, looking to get some of their money back, and maybe the opportunities for growth that you thought were there are no longer there, how successful will those types of companies be in executing a transaction with an outside investor or a strategic partner in order to kind of help save the business before it's too late? Do you think we'll see breweries actually be able to pull that off?
Well, you can't generalize. I think it comes down to the specifics, and we've as much discussed that today the importance for health in a brand is innovation, creating a consumer experience, having a workable business model, and generating revenue, sufficient revenue stream from productive capacity. I think when those things are aligned, and if it's just a question of excess debt against a healthy brand and business model, then the opportunity to add volume through collaboration with other brewers seeking volume or going outside for it, it's going to come down to the specifics of the plan rather than the generalization about the whole market. There's always going to be an opportunity to attract financing, with the right plan.
Yeah. Well, great stuff as always, Tony. Thank you so much again for joining me. And will we see you in Santa Monica this year again at Brewbound Live?
Absolutely. I'm looking forward to seeing you there. Tread carefully in the jungle.
I will. Thanks, Tony.